class. Today we go to chapter 5, capital structure theories. Do you remember in chapter 1, one important corporate finance decision is financing decision. So financing decision is the decision on how much should the firm borrow or how much is the percentage of debt in the capital structure of the firm. Yeah, WD. WD. Okay, so this question doesn't have an easy answer. Okay, and this issue is not settled in both theory and practice. Well, if a firm use too much debt, yeah, then it's increase the risk of being filed for bankruptcy, right? Because yeah, when the firm is heavily indebted, it may have large financial obligation, and it's more likely to fail to meet the financial obligation. For example, the firm may fail to pay the interest or the principal for the loan or for the bondholder. Yeah. So at that moment, the firm may be filed for bankruptcy. So, but when the firm use too less debt, and in chapter 4 that debt is usually cheaper than equity, right? And WACC is the cost of the company, and we want to minimize that cost. And of course, to minimize that cost, we have to use the cheaper source of capital, and that is debt, right? Yeah. So debt is a double-edged sword. What does that mean? It means that when debt is used wisely, it can enormously boost the financial performance of the company. But when it does not used wisely, yeah, and you make the wrong financial decision, then debt can hurt you, can bite you a lot. So in this chapter, we had to we're going to discuss. We're going to focus on how the capital structure. We're going to discuss the leverage, yeah, the WD of the company, and we will see that a balance between debt and equity is the key point. Okay. This is a chapter outline. We're going to, in the first session, in the first part of this chapter, we're going to study some basic terminology related to capital structure, like capital restructure, financial leverage, and we will learn how financial leverage affect ROE and EPS of the company. And ROE and EPS are return on equity and earning per shares that are the basic criteria for that gain the large interest from shareholder. And in the latest part of this chapter, we're going to study the capital structure theories that explain the choice of leverage. Yeah. Okay. First of all, capital restructuring. Restructuring means tái cấu trúc. Okay. So that involves changing the amount of leverage that a firm has, but without changing the firm assets. So what does that mean? So this is the pie of the firm. Yeah, this is the liability, the capital of the firm. Okay, and this capital has from debt and from equity. Okay, and okay, so we increase or we change the WD and we change the WE, yeah, but we don't change the size of this pie, yeah, so we call capital structure restructure. So I can change the size of debt and equity. Yeah, for example, I do like this, yeah, 50% debt and 50% of equity, but the size of the pie remain unchanged. Okay, and how? So either we increase the leverage and we decrease equity, or we decrease leverage and that also means we increase equity. We increase leverage. How? We borrow more. Yeah, we borrow more. We issuing debt. Okay, and because the pie has to be unchanged, so we use that money, yeah, to repurchase outstanding share, more like cổ phiếu đang lưu hành. So by buying, repurchase outstanding share means you purchase your old stocks, yeah, and that also means you cancel those stocks, so you decrease the equity of the company, yeah. Yes, so by doing so, the liability or the assets of the company remain unchanged. And we can also decrease the leverage by paying back the debt. Yeah, retiring outstanding debt nghĩa là trả tiền, trả nợ các bạn ha. And where did the money come from? We issuing new shares. Yeah, issuing new share. We issue share, we get the money, and we use that money to pay debt. Okay, so by doing so, the WD decrease and WE increase, but the total liability and the total assets remain unchanged, and we call that capital restructuring. And choosing a capital structure is very important for the firm because, okay, remember the ultimate goal of financial manager that is we maximize the stockholder wealth. And in order to maximize the stockholder wealth, we maximize the stock value or in a way, in another meaning that I maximize the firm's value, that we have to minimize the cost. Yeah, at the same time, we have to minimize the cost. That is, we need minimize the WACC. And why is that? Because WACC, it had capital structure. Remember the formula of the WACC? So WACC is a function of WD, WE, RD, RE, and corporate tax rate, corporate income tax rate. Yeah. Okay, take a look at one example to see how using leverage is a double-edged sword. Yeah, affect EBS and ROE. Okay, look at this example. In this example, remember we ignore the effect of taxes, mean, okay, we assume that there are no tax. And what happened to EPS and ROE when we issue debt and buy back share of the stock? So this is the current situation. The total assets is $8 million. We have no debt, zero. And all the capital come from equity. So debt and equity ratio is zero. The share price is $20 per stock. And the share outstanding, of course, that is 400,000. Yeah, and how do you come up with this number? You take 8 million here, and you divide it for 20, and you have 400 million stocks. And interest rate, we had 10%, but it had no meaning in the current situation because we had no debt. And the proposed capital structure is, okay, now we issue debt. Yeah, we borrow 4 billions. So it's 50-50, 50% from debt and 50% from equity. We borrow 4 millions, yeah, and we use this borrowing to buy back stock. Yeah, to buy back stock. We buy back 4 million. That's why we decrease the equity from 8 million to 4 million. Yeah, to 4 millions. And the debt equity ratio is 1, is 50-50. The share price, remember, it stay $20, and the debt here and the equity here, we take 4 million here, we divide it for 20, and we get this number. Yeah, and the interest rate, 10%. Okay, and now given the situation in the economy, we will have three scenarios. Okay, recession and expected and expansion. So if the economy is in recession, then the projected EBIT is $500,000. And if the economy is expected, then this is the EBIT. And if the economy is good position, mean in expansion, we got EBIT $1,500,000. So EBIT is given, okay? And the rest you have to calculate yourself. The same, this is for current capital structure where you know debt, and we do the same with the proposed capital structure with debt, okay? So EBIT, this number is given, and the rest you have to calculate yourself. And how? I'm gonna guide you. So focus on the current situation. We know debt, so interest is 0, 0, 0. Agree? So the net income, remember we ignore tax, so there are no tax. Yes, the net income equal to EBIT subtract for interest. Yeah, yeah. And ROE is net income and divided for equity. Okay, so this 6.25% is from we take 500,000 here and divided for equity, in this case 8 millions. Yes, 8 millions. Okay, and we do the same. And EPS is equal to net income divided by number of stocks. Okay, so this is 500,000 divided 400,000, and we have that number. I will do the same for the other two scenarios, that is static and expansion. And in the proposed capital structure, we also do similarly, but remember here we have debt, so interest is not zero, interest is a positive number. So 400,000 here is this one is 10% and multiply for debt. Yeah, yeah. And in any case, we have the same debt, so it's equal to 400,000 per in any scenario. And we do the same, net income equal to EBIT subtracted for I. Yeah, and the rest of the table is the same as the above, the same calculation. Okay, and look at the result. What do we have? Look at the result. EPS, we compare the two plans. One is the current situation and one is the proposed capital structure. And in both cases, look at ROE and EPS, how the difference between them. ROE in current capital structure, no debt, rank from 6.25% to 18.75%. So the gap between the lowest and the high is about 12%. And ROE in the proposed capital structure, that rank from 2.5% to 7.5%. So the gap between the highest and the lowest is about 24%. So it's double in comparison to the current capital structure without debt. What does that mean? It means that in the second choice, in the capital structure with debt, the ROEs are very more, yeah, volatile more, right? Volatile more. And what does that mean? What does that imply? It implies that the ROE that is riskier for shareholder. Yes, riskier for shareholder when the firm use debt because ROE now fluctuate a lot. And just the same observation for EPS. EPS in the no debt situation range from 1.25 to 3.75. But here it range from 0.5 to 5.50. So it also fluctuate a lot in the debt situation. Okay, so the first observation is it is riskier for shareholder when the company they use debt. Okay, and regarding the size of ROE and EPS, if you look at the current capital structure, ROE and EPS, is generally lower than that in the proposed capital structure. For example, for in case of expansion, ROE in this case only ROE in the first case is only 18.75%, while in the second case study, when we use debt, is increased substantially to 27.5%. And the same with ROE, with EPS. EPS increased a lot. Yeah, but when in recession, the ROE and EPS with no debt, is higher than ROE and EPS in the capital structure with debt. Okay, so what does that mean? Well, it illustrates the double-edged sword of debt. Yeah, when it's rainy, mean in recession. Yeah, using debt can hurt your performance. Yeah, you see, ROE and EPS in the proposed capital structure is pretty low. And why is that? Because whatever your performance is, you had to pay fixed interest rate. You had to pay this number. That is the key point. Even your performance is not good, even the economy is not as good as expected, you still had to pay a fixed amount of interest payment. And if the situation is good as expected, like in expansion, well, you don't increase the interest amount you had to pay, but you increase the EBIT, means the profit. So what is left for the shareholder also increase here. So when the performance is good, using debt can increase, can boost the performance, can boost the performance of the company. But okay, so you may see that there's a point that before reaching that point, we should not use debt. And after that point, we should use debt. So we call that point is break-even point. Điểm hòa vốn. Okay? So look at this figure. I draw the figure, I draw the horizontal axis to see EBIT. EBIT. And this is the EPS. Okay, so based on this table, I draw the line to express the relationship between EBIT and EPS. Okay, and of course, in order to make a line, you need only 2 points. And in our example, we have 3 points. That's more than enough. Okay, the current structure, no debt, is the black line, and the proposed capital structure is the pink line. And in the black line and the pink line, you see it crosses at one point. And at this point, they have the same EPS and the same EBIT, right? Yeah. Sorry. So I make this equation. I calculate the EPS of the current plan equal to the EPS of the proposed plan. Yeah, and that equal to EPS of the current plan is how to measure. Yeah, it's equal to net income divided by number of stock. Okay, and the net income is essentially the EBIT because there are no interest. So this is the formula EBIT divided for this is the number of stocks in the current capital structure. And this is the net income of the proposed capital structure. We take EBIT subtracted for this is interest, right? And this is the number of stock. And then we show the equation for EBIT and we get $800,000. And we replace the $800,000 to get the EPS. So at this point, EPS is 2 and EBIT is $800,000. So what can we offer is if the EBIT, if the projected EBIT is smaller than, is less than $800,000, then we recommend we stay in the current capital structure because you see the black line is above the pink line. What that means the black line offer higher EPS for the same EBIT, right? Yeah, so if the EBIT, the projected EBIT is less than $800,000, we propose stay at the current situation, no debt. But if the projected EBIT is greater than $800,000, mean here, yeah, we propose you take the proposed plans that we use debt. So, and at the point 800,000 EBIT, $800,000, we are indifferent between the two plan, stay at the current situation or take debt. Okay. So from this example, it illustrates that the shareholder are exposed to more risk under the proposed capital structure because EPS and ROE are much more sensitive to the change in EBIT in this case. And because of that impact, because when using debt, the shareholder risk increase. Therefore, the impact the financial leverage on the shareholders' risk is significant and should not be ignored. Yeah. And that's why the capital structure is very important decision. It's very had to be in a great consideration. Yes. Okay. Now we know that how the financial leverage can affect the risk of the shareholder. We now move to the second part of chapter 5 that we use the capital structure theory to explain the capital structure decision. And in capital structure theories, we are going to discuss the Martiglia-Ani and Muller M&M. Yeah, standardization. The abbreviation is M&M theory of capital structure.